It tells us. Okay, I see the attendees sort of just slowly piling in. Okay, we'll give it a couple minutes, Duwi, and then we'll kick it off.
Sounds
Maybe
good.
give it 1 minute.
Perfect.
All right, Duwi, let's kick it off.
Perfect. Welcome everyone, and thank you for joining our webinar today. My name is Duwi Yogeswaran, and before we get underway with our main event, I'd like to take a couple minutes to introduce our organization and its mission, as well as talk about upcoming events and opportunities for you guys to get involved with us. For those of you who aren't familiar, Tamils in Finance was founded in 2018 by a small group of us who had a common desire to centralize the network of Canadian Tamil financial services professionals. We wanted to do this with the intent of providing members with a unique opportunity to mentor and support each other, purposefully grow professional networks, and increase the collective influence of our community within the Canadian financial services sector. Our three core pillars include networking, mentorship, and thought leadership. As part of the mentorship initiative, we just completed the pilot run of our leadership development program, in which we paired budding professionals in our community with seasoned leaders and executives to help guide them as they progress in their careers. Despite the challenges posed by the pandemic on in-person networking, we were very happy with the results of the program. And on the heels of this success, we'll be launching a new iteration in the fall. So whether you'd like to mentor or mentee or know someone that would like to participate in our next iteration, please stay tuned for updates on how you can get involved. Additionally, we're looking for a volunteer marketing associate, and we'll be posting an ad for this position soon. So please keep your eyes peeled if this is something that would interest you. The final upcoming line item I would like to address is a career development panel we're planning to hold this fall. A focus of this panel will be navigating your career in this new and unknown environment. Should be a very interesting and timely topic for many of you, so please stay tuned for details on this event. We also want to share some exciting news. We're proud to share that the Globe and Mail today has selected Tamils in Finance co-founder Roy Ratnavale as one of the winners of the Report in Business magazine's inaugural 2020 Best Executive Awards in the Sales and Marketing category. He will be officially awarded this fall and will be featured editorially in the November 2020 issue of the magazine, so make sure to grab your copy then. Before we carry on with the panel, we also wanted to note that equal representation and increasing it within the financial services industry is something that's often focused on, and rightly so. Our organization is no different. As you can see, we have an all-male panel today, but increasing diversity within our own organization is certainly something we're focused on. Even though two of our co-founders, including myself, are female, and we've been intentional about gender representation and inclusivity from the beginning, we know we have a lot more work to do. This will be something that we continue to put our efforts into, and we also ask for your help in spreading information about our organization to your circles and to encourage females in our community who work in the financial services to please get in touch with us. Without further ado, let's get to the panel portion of our program and meet our moderator and our panelists today. Thank you.
Thanks for that, Dewey, and appreciate the introduction and all the background information today. Appreciate that. Quickly, just want to highlight the fact that this is going to be a panel discussion on COVID and the financial markets. So what we're going to do here for the agenda today is we've set aside 40 minutes for sort of a pre-canned Q&A session with our featured panelists, and then we're giving everyone the opportunity to take advantage of the Q&A feature at the bottom of your screen. So please submit that through. We're monitoring the questions there, so feel free to ask some questions throughout, and we'll do our best at the end for about 10 to 15 minutes to address some of those. So please definitely take advantage of that. So with that, I want to start a quick introduction on our panelists. So today we have Rohan Thiru, Portfolio Manager from Canoe Financial. Rohan has more than 15 years of investment experience. Prior to joining Canoe, he was a credit portfolio analyst at Dynamic and was a credit research associate at RBC Fixed Income Capital Markets. Rohan has a Bachelor of Mathematics and a Master's in Accounting from the University of Waterloo. He holds the Chartered Accountant and the Chartered Financial Analyst designations. Rohan is also a board member leading the Finance and Responsible Investments portfolio at Conduit. So welcome, Rohan. Shri Thanabalasingam. So we have Shri, who is a senior economist for TD Bank Group. In his role, Shri tracks macroeconomic developments across major economies, including the US, Canada, Eurozone, and China. He regularly provides data commentaries and produces analysis on a wide variety of macroeconomic issues. Prior to joining TD, Shri was a senior economist at the Bank of Canada, where he helped construct the economic forecast featured in the bank's monetary policy report. His research has been published in a variety of academic forums, and he has presented his work at conferences all across North America and Europe. And last but not least, we have Gajan Kulasingam, Portfolio Manager at Goodwood. Gajan brings more than 17 years of financial services experience covering audit and assurance, corporate finance, private equity, mezz debt lending, and public equities. Gajan currently serves as the lead portfolio manager of the Goodwood Capital Fund. Goodwood is a Toronto-based independent investment management firm that provides its clients with alternative investment strategies for over 20 years. Prior to joining Goodwood, Gajan was a VP and senior portfolio manager at Century Investments, where he was responsible for the management of in excess of $1 billion in assets under management across multiple mandates, including infrastructure, small to mid-cap equities, and global equities. Gajan has a Bachelor of Commerce degree from the University of Toronto and holds the CFA and the CPA designations. So welcome, everyone. So I want to start off with Shri as our lead economist on the call today. Shri, can you talk about how we got to the current state of the economy and the impact that COVID is actually having on the economy?
Sure. Again, thank you all for having me here today. So in terms of the impact of COVID on the economy, I just want to start with how things ended up in 2019 in terms of both the global and the Canadian economies. So on the global side, we were seeing the US-China trade war weighing on global trade as well as overall global economic activity. And we also saw a slowdown in terms of the manufacturing sector. So both of these were acting as headwinds in terms of global economic activity, and that was feeding into Canada through the trade channel, more or less. But then one of the bigger impacts for Canada wasn't the US-China trade war. It was the US, I would say, conflict with Canada in terms of the NAFTA, the North American Free Trade Agreement renegotiations that started up in 2017 and lasted all the way through 2019, and the uncertainty that was posing and the impact on business investment. At the same time, you also had high household debt that was weighing on consumption, and then you had labor disruptions in terms of strikes, as well as auto plant closures. So all of these were acting as headwinds in terms of the impact on Canadian economy, and that's when COVID-19 in early 2020 came onto the scene, really causing a devastating impact for Canada as well as the global economy. For Canada, we've seen millions of job losses, particularly in lower paying sectors. And that's just highlighting the impact this sort of economic crisis, and this is definitely a health crisis that transformed into an economic one, it has on vulnerable parts of the population. So that's significant because it just doesn't stay within that part of the population. It propagates to the rest of the economy. And so Canada is facing this significant downturn right now. And then there were mandated closures of non-essential businesses and social distancing measures, and people generally being very afraid of resuming regular economic activity. So all of that is really weighing on the Canadian economy at the moment. And as provinces reopen their economies in May as well as June, we're starting to see some recovery there. But still, the level of activity is nowhere close to where it was at the end of 2019. We at TD were expecting the output in the second quarter of this year to be about 12% lower than where it was at the end of 2019. So that would be the current state of the economy as we see it.
Perfect. Thanks for that, Sri. And I appreciate that background, and that's a great way to sort of set the table and sort of talk about the state of the economy. So I want to sort of just like maybe shift gears and think more forward looking. So if we look back to when COVID sort of occurred, one of the big types of conversations was like, how is this recovery going to look, right? And what's the outlook like? And I think people were using various letters, V-shape, U-shape, W-shape, right? So what are you monitoring to determine the shape of this economic recovery coming out of the downturn?
Sure. So in terms of the outlook, more of a general comment here, there's a lot of uncertainty. And as I had mentioned in the first response, this is a health crisis that transformed into an economic one. And so we definitely need a health solution. And when that health solution might come is very much anyone's guess. And that, in effect, will truly determine how we see the economic recovery progressing. And so you would have to make assumptions in terms of how you when that health solution will come through, and under the assumption that it happens sometimes in 2021 and not anytime soon, we should see more of a gradual recovery in terms of economic activity. What we have is more of a Nike swoosh shaped recovery. So we have the initial reopening, so that creates a bit of a V after the drop in economic activity. After that, it's a gradual return to pre-COVID levels of output. So what we have in our forecast is by mid-2021, we get back to where we were in 2019. So it takes some time. In terms of the economic indicators that we're looking at high frequency indicators, because these traditional indicators, they could be backward looking. They're released with a lag period, about a month, 2 months. And given everything that's happening on the ground in terms of the evolution of the virus and the infection rates and that sort of thing, we're turning to high frequency indicators. Some of the indicators we're looking at are Google mobility trends, which tracks location data, how people are working with social distancing guidelines and the reduction of those social distancing guidelines. And we're seeing that in Canada as well as other economies, as well as provinces. We're looking at open table diners going to restaurants, whether they're resuming activity as normal again. And there we're seeing things kind of flatten out again with the concerns of the virus, especially in indoor diners, restaurants, and bars. And finally, we're also looking at debit and credit card transaction data, and this is something that we at TD have internally and other banks as well to measure how consumers are returning to their spending habits. And right now, things do look a little bit weaker than what they were, but Canadian credit card and debit card transaction data looks better than what we're seeing in the U.S. And the U.S., we're seeing a resurgence of this virus, and some of this high frequency data is showing us that there's a change in consumer behavior in the U.S., and that is a little concerning, because if consumers start behaving differently and really bring this into their psyche, and there's a loss of consumer confidence, that could leave scarring effects in terms of the economy. So that's something that we're also closely looking at.
I appreciate that, and that's sort of a good segue into the next question. Like, you're talking about the consumer confidence and the U.S. being a very consumer-driven economy. So let me shift over here to Gajan. So, like, despite the economic concerns and pandemic concerns, the equity markets clearly have rebounded, and probably faster than I would have personally anticipated. Why is there the disconnect, and what is like your outlook on equity markets?
Sure. Thanks for having me, and thanks for the question. So I think there's a bunch of reasons, and some of them is technical, and some of them are fundamental, as we call them. On the first thing, the stock market, and here when I say stock market, I'm talking about kind of the S&P 500, because that's kind of the most broadest representation, the most efficient stock market in the world, I would say. So the stock market, if you think about the S&P 500, doesn't necessarily reflect the economy. And when I say that, because if you think about how the stock market's created, it's an aggregation of a bunch of companies and a bunch of industries and a bunch of sectors, right? So the easiest way to kind of make that point is if you think about the energy weighting in the S&P 500, which is kind of the largest, most efficient market capitalization index in the world, the energy weighting is around 2.8%. That's all what energy represents in the S&P 500. But in reality, in our world, day-to-day world, obviously energy is far more important than just a 2.8% in our day-to-day life, whether it's upstream, downstream, gasoline, and all the trickle on the second and third derivative effects, right? So from our perspective, I think the way you look at the market is, there is a disconnect between the S&P 500 and the economy because of the way it's structured. And in the S&P 500, 40% of it is tech and consumer services industry. So that's a large disconnect between how the market's constructed and what the underlying economy represents. So that's one reason why the market's had a really strong rally, because it's called what we call the internals of the market have shifted, right? So a lot of the people in the stock market have sold kind of the old COVID legacy businesses and bought a lot of the tech businesses. So the Amazons, the Microsoft, the Googles, the Apples, and a whole bunch of other SaaS related businesses. And those disproportionately represent a higher weight in the index. So that index has gone up while kind of the other businesses have been left behind. And the way you can even look at that is if you think about the S&P 500 on a market capitalization basis, so that means the most valuable companies drive the majority of the index. That index on a market capitalization basis is almost flat year to date, which is what everyone's looking at. Everyone's like, wow, how is the S&P almost flat year to date? But if you look at the S&P 500 on an equal weighted basis, so that means each company has an equal representation in the index weight, that index is down 14% year to date. So you can clearly see a handful of companies have pulled the entire index up, and that's what everyone's looking at, saying, how is the market coming back so much? Another index is the Russell 2000, which is probably the most broadest representation of the North American, US in this case, the US markets, small and medium businesses. That index is down 14%. So, we look at that and say, okay, there's clearly a disconnect, but that disconnect is really explained by the market construct of the indexes versus the underlying economy. The second big reason is, as always, and it should be, the market is a very forward-looking mechanism, right? And it doesn't look beyond just one quarter. It technically should look into 5, 6, 10 years forward and then discount that back. So if you think the market is an efficient forward-looking mechanism that can price assets backwards, it's looking at beyond what's happening today in the market, and it's looking at 2021, 2022, even to some degree 2025 and onwards, right? And the market's trying to figure out, okay, what does the world look like 2022 and onwards? And, is this COVID pandemic temporary or permanent? I think that's really kind of the world that's the pendulum the market's going to swing towards, where, the impact of the COVID as it is today, is it temporary or permanent? And clearly the market's telling you some degree that this is temporary, that there will be a return to some level of normalcy. But going forward, the winners that were in the past are not going to be the winners in the future. I think that's from a stock picking and equity selection perspective. Our job is to figure out what is the market pricing in, and do I agree or disagree with that, and take my trades in accordance with my view. And so I think stock selection is going to become very critical going forward, because it's going to be much more specific to macro fundamentals, to economic recovery, how COVID vaccine works out, and all that is going to change the market fluidity very fast towards, pre-COVID and post-COVID businesses. But you won't see all that at the market level. It's really kind of the analogy of the iceberg, right? Like everything looks really nice and smooth above the water, but underneath there's all kinds of chaos underneath the iceberg. So I think people, I would say, while the people are saying the market's saying everything's recovered, it's really not. If you look at the underlying fundamentals, there is a lot of damage in the market. And to some degree, it does tell you that there's still a lot of damage that needs to be repaired at the market level too. And that in itself is where some of the opportunities are.
No, right. No, I appreciate that. That's a great sort of explanation there. And I really like how you talked about sort of the big getting bigger and that explanation of like the S&P 500 being driven by the top end. And one thing I want to talk about there, like you're seeing on the top end, like a lot of growth names, names that to that point about discounting back are being discounted back at like significantly lower rates. And I think that ties into my next question where I want to get my fixed income subject matter expert to maybe take a stab at this. So low rates are clearly driving a lot of things in the economy today. So a consequence of the challenges of this economy and the pandemic clearly has been lower rates. So Rohan, can you talk about your view on the economy, specifically around your view on the risk and the implications of negative rates, something that we've talked about quite extensively?
Very good question, Akilan. Again, thanks for having me, Gajan, Sri, some of the smartest guys on the street you have. So very honored to be sharing the panel with Gajan and Sri. As I am addressing your question, I'm going to try to address some of the questions that have been asked on the panel. Anderson, Peter George, and Nero Ganeshan, and then asked a bunch of geopolitical questions, which I would love to talk about as well. So Gajan is an equity guy. They are always uber bullish on everything. They're just happy-go-lucky guys. As a fixed income guy, I'm always negative. That just drives my thesis. So I want to take what Sri has said, and I want to take what Gajan has said and sort of marry them together and give you a view on what I am thinking. So I am very concerned. Just to summarize my thinking, I'm very concerned about global growth. I'm concerned about risk assets, specifically equities. And in my view, rates are going to zero and negative in North America. Why do I think that? Even before COVID hit, global growth peaked in 2018. Why do I say that? The last decade, growth was extremely strong, and majority of that global growth, Akilan, came from China. China's GDP tripled over the last decade from 5 to 15 trillion. All of that was driven by financial leverage. Now, what's happening to China right now? They're decoupling from the US. The trade war is here to stay, and Sri will talk about this for days. It's here to stay. It's not going away. The manufacturing hub China was, it's going away. And unfortunately, China has been trying to become a consumption-driven economy, which they're not going to be able to. Why? Because of demographics. They're aging faster than any other country in the world. Because of the one-child policy in late 1970s, they're running out of people to put to work. So from a consumption point of view, they're not like the US. US economy is 70% consumption driven. China is far less than that. Until you have a consumption driven economy, you always rely on global growth. And with globalization, trade, as we know it, deglobalization is happening, China is going to be left behind. Third reason is the amount of leverage in the financial system. If you take China's financial leverage, that's 50% more than the US and Japan combined together. That's meaningful. So as a result of that, Chinese Communist Party has systematically pulled back on credit growth. So because of pulling back on credit growth, issues with demographics and deglobalization, China is slowing down and not going to be the engine of growth going forward. And then I look globally to see where growth is going to come from. It's not going to come from Europe. You're going to see Brexit. Brexit is going to happen. That's going to shrink the UK economy by 10%. Germany, which is the largest economy in Europe, 50% of the GDP in Germany is exposed to exports. And with China slowing down, Germany is going to go into recession. It's already in a recession. It's not going to come back. And then you have France. And France has structural issues with employment. Again, for these reasons, Europe is not going to be the engine of growth. US is slightly positive versus China. But the problem I have with the US is, again, goes back to demographics. Over the last 10 years, growth was okay, mostly because of baby boomers. What's happening with the baby boomer cohort is that they're all retiring. And the next largest cohort that is going to be picking up the spending is going to be the millennials. Millennials were born after 1981 on. Now, what's the problem with that thesis? Everyone tells you, yeah, baby boomers are gone, but the millennials are going to pick up the spending. The problem with that is that anyone who was born after 1981, they went to college during the during the dot-com bubble. Okay, and they were looking for co-op terms when the tech bubble burst. They were looking for a full-time, they graduated and were looking for a full-time job during the great financial crisis. And now they're trying to buy a home and settle down and have kids during the COVID. So before they turned 40, they went through 3 great financial crises. What does it mean? What that means is that they were left behind when the housing boom happened. They were left behind when the greatest stock rally happened. So they're all getting out with a lot of debt because they are the most highly educated cohort. A lot of them went to college. But the problem with that is that they have a massively overblown leverage on the balance sheet. A lot of student debt, massive wealth disparity because they did not participate in the stock rally and the housing boom. So what happens? They have too much debt, can't pick up the spending. So for that reason, there's a structural issue with the US economy and the Canadian economy for that matter, that we're not going to be able to get out of this. So while the risk assets are rallying purely on central bank liquidity, it's a short-term rally. Now, if a vaccine were to come out over the next 6 months, which is overly optimistic, in my view, and talking to a lot of experts, in the past, historically, it has taken 5 to 10 years for a vaccine to be developed. The trial phase, just making sure there's no side effects. Now, all hands on deck, you actually manage to get a vaccine developed over the next 2 years, go through the trial phase, make sure there's no side effects. You're not injecting people, 7 billion people with all kinds of stuff. Then get it manufactured and have 7 billion vaccines available. It's going to take many, many years. So till that happens, you're going to see the global economy function at lower than capacity. For example, China is running at 90% capacity and they don't have any cases or minimal cases. That's 10% shrinkage in GDP. During the great financial crisis, the US economy shrank by 5% and unemployment spiked to 10%. So my point is, everyone is being overly optimistic about the vaccine, about the central bank liquidity. My concern is that the slowdown is here to stay here for a long time, and it's going to be a painful, painful recovery. And we are never going to get back to the peaks in growth that we saw in 2018. Now, to address your negative interest rate question, now rates are driven by growth, real growth in the economy, and inflation. Now, I just told you why growth is not going to come back to the peaks we saw. So you're going to see rates drop to 0. And in my view, it's going to negative. The problem with negative rates, Akilan, is that it does not work. The thing is that central banks only have one tool, play with negative rates and QE now. But they'll continue to drop rates. But look what happened to Japan and the European Union. Negative rates have killed the financial system. The banks can't function. And when the banks can't function, there's no credit growth. Why do I say that? When rates go to negative, depositors like myself who go to the bank to deposit money, all of a sudden have to start paying the bank for them to keep the money. So I start taking the money out. Deposits leave the banking system. The cheap funding that the banks have are gone now. Cost of funding for the banks go higher, and the banks start tightening the belt. They stop lending. And when the banks stop lending, there's no credit growth. And without credit growth, the economy doesn't grow. Second reason why negative rates don't work, central banks ideally try to bring down rates so that it's cheap to borrow and spend. What's happened in Europe is the opposite effect has happened. When rates have dropped, people who are looking to save for the long term have to save more now because the future income stream from interest income is going to be lower. So they have cut back on spending to save more. So for that reason, negative rates are extremely bad for the economy and the banking system, and it just produces more stagnation.
For sure. Appreciate
If I
that.
could just add a comment to that. I know Rohan kind of said equity guys are uber bullish, and so I think in general that's true. But I would actually kind of, even on the equity side, I would argue that there's more downside risks to the economy and to the market than there are upside. I mean, if you think about kind of the risk reward spectrum or the probability distribution of events that can happen, there's maybe 2 or 3 things that can go right. And in order for those things to go right, everything has to happen right. There's probably about 5 or 7 things that can go wrong. And if any one of those things go wrong, it can go really wrong. So I would actually second Rohan's opinion in the sense that I think the market at a high level is mispricing risk versus return. And it is a bit more overly optimistic. And the other thing I would say is there is a lot of noise in the market structure because of passive investing and quantitative investments. And so the price discovery mechanism that the market used to give doesn't work as much anymore today. 20 years ago, when a market priced something, it told you something. I think when a market prices something today, it doesn't tell you as much because there's so much polluted participants in the market today. The noise effect is quite large. So to take it all away, I would say, like, I think it's in line with kind of the bond market. The underlying equity kind of guys are somewhat as relatively neutral to bearish as well. And we think, there's more risk to the downside than upside as well.
And sorry, Ahil, sorry, go ahead, Sri.
No, I felt like I needed to balance things out a little bit, even though there might be downside risks to the economy as well, and there definitely are. But I think there are some upside to it as well. On China, for example, I don't necessarily fully agree with what Rohan has said. It's not pure leverage growth. China is an emerging market and is trying to catch up to advanced economies in terms of productivity and getting to an advanced economy status. And one of the issues is they have a very high savings rate, and so as long as they have some sort of increase or better social safety net, they should be able to spend more. And that is the case with a lot of emerging markets wanting to catch up. So these are structural changes, and there is growth potential there for emerging markets. But with this virus, it's just it's keeping that all down, and without a solution, it is tough to get back to full operating capacity, as Rohan mentioned. But I'm still holding out that we see some sort of health solution in 2021.
And just one more thing I should address. Anderson Peter George was asking about the US elections. I do have a view on it, a strong view on it. In my view, Trump is not going to get a second term. That's also bad for risk assets. Just purely, forget the fact that COVID crisis in the US was mainly caused by him because he was not really serious about it. It's very hard for a sitting president to get a second term when an economy is going through a recession and unemployment is at historical highs. Leaving all that aside, just purely based on demographics, if you look at the largest cohort right now is Gen Zs, people who are born after 1991. Now, what's important about them? These are people who were not 18 back in 2016 when Trump got elected, but majority of them have turned 18 now. And what these guys care about is wealth disparity, income equality, a greener environment, and social justice. Given these guys can finally vote now, and Trump won by a small margin back in 2016, and the Gen Zs are socially more active when it comes to social media, a lot more vocal about their view. For that reason alone, Trump is gone. And when Trump is gone, Biden comes back, he's going to govern from the left, meaning personal tax rates are going higher. Corporate tax rates that Trump introduced, lower corporate taxes Trump introduced, are going to eventually go higher under Biden. Those are all bad for risk assets. So that's the implication of Trump losing, Biden coming in, and hopefully Biden can eventually, focus on domestic politics instead of international politics, because I think Biden is going to take over the Congress, House, and the Senate, which usually means he'll focus more on the domestic stuff. That also means increased wealth tax. All of this stuff is going to be bad for risk assets. So just something to keep an eye on.
For sure, yeah, and I would agree with sort of the implications of the election results. I would agree with most of that for sure. So I think I want to shift a little bit, and that was great. Appreciate all of your views on that. So, and we have a lot of millennials on the call and attendees. So something that probably relates to everyone is, and Shri, maybe you can kick this one off. So one concern is Canada, from having lower rates, there's a risk of a housing bubble. At a time when there are a risk of job losses, high debt loads, and the possibility of government support tapering, how concerned are you about housing prices and debt levels being elevated through lower rates, as Rohan had touched upon?
It definitely is concerning. Household debt was one of the key is one of the key vulnerabilities for the Canadian economy. I think it sits around 165% in terms of personal income or disposable income. So it definitely is concerning, and it's something that the regulators were looking at previously and continue to look at, both as well as Bank of Canada. So it's a little strange at the moment that you could have this much economic turmoil, but then the housing market looks like it's bouncing back and returning back to its hot levels prior to COVID-19, and what's really behind that. And it seems that people who were not as impacted by this pandemic so far, who have not lost employment, so these white-collar workers, as well as first-time home buyers, and these millennials that have been sitting on the sideline, are now looking to take advantage of the crisis in itself and move into the housing market. As long as they have a job and can afford that mortgage, it's not bad debt that they would be adding in terms of making it more vulnerable in a sense, and they would still if they could still qualify for that mortgage through the stress test that regulators put in previously, then it might not be that bad a thing. Where the concern, or where my concern really is if they add this debt or bring on a mortgage and then they lose their job. So this comes back again to the a resurgence of the virus, or some sort of trigger which leads to more employment declines, and now not just in terms of blue collar workers and lower income workers where home ownership rate was already quite low, but now into the white collar side, that could lead to some sort of a vicious downturn. So we end up going from expecting a V shape to a swoosh, Nike swoosh shape. Now it's a W shaped sort of recovery, and at that point, it definitely is a key vulnerability that could end up with both spending, consumer spending coming down, and then feeding then into the investment side, and then the overall economy continuing to contract, leading to a prolonged recession.
If I could just add a couple of points there, I think if you think about any market, equities, fixed income, housing markets, there's the economic side, which is supply demand, and then there's the behavioral side, which is psychological. And I think those two often interact and cross. And in the housing market, you're seeing that probably the most clear, right? There is a supply demand disconnect in the housing market. There's no doubt about it. There's so many people coming in, immigration, baby boomers growing out, millennials going out of the house looking for first-time houses. There's certainly a shortage of supply that's causing part of this housing price appreciation, and I think that's a real economic issue that's not going to get addressed anytime soon. I think we're going to have perpetually undersupplied housing market, particularly in like Ontario, the GTA, Toronto, where there's a high demand for labor, but tremendous shortage of kind of single detached houses. On the other side is the behavioral side, which is kind of, I think a lot of people might have waited thinking there's going to be an opportunity to come back into the housing market, and then they didn't really see it, or maybe it happened 1 month in April, and then you start to see another uptick in housing prices, and all of a sudden kind of FOMO kicks in, or everyone just says, okay, I can't wait anymore because it's just going to keep going up. And kind of the headlines in the world today, you know, social media and the digital revolution has so many headlines coming at you saying, you know, housing prices are going up year over year, inventory is down, and all this stuff. So I think a lot of people who waited, even though their economic and their working conditions might be somewhat unstable, are still going to take the risk and say, I can't wait anymore, because the longer I wait, the more housing prices go up. So then you get this flood of people coming into the market. So I think you're seeing a little bit of that today. And I think, you know, Shri is right, that the real issue will be when unemployment trickles into the housing market. And I think, you know, the timing for that is unknown, but I think there is a real risk that will materialize, and we have to watch for that.
I just want to follow up on the immigration point that you made there. Immigration is a crucial driver for overall Canadian economy, and specifically on the housing market. You know, I think Canada was the top attractor of immigrants for the last 5 years or so amongst G7, G10 countries, because it's been very, very welcoming and has set very ambitious immigration targets. And so it really depends on the outlook for immigration, how immigration evolves going forward. And then that's impact on housing. Immigration came to, you know, a near halt in April as Canada closed its borders to some extent, and COVID-19 raised concerns around the world. But Canada has not let go of those immigration targets. They are still trying to hit that 200,000 or so. And at the same time, everything that's happening down south with Trump and his policies on immigration, it's pushing more immigration into Canada. So you might not see it kind of happen this year. Maybe it doesn't. Maybe we don't hit the target by end 2020. But then moving into 2021, Canada still remains a very attractive place for immigrants to come to, and specifically metropolitan areas like Toronto, as what Gajan said.
Just one more thing to what Sri said. You know, one thing I'm positive on is the immigration story in Canada. If you look at, you know, if you look at where people ideally go, they ideally like to go to English-speaking countries. There are, whether you like it or not, there are only 7 English-speaking countries in the world: Australia, New Zealand, South Africa, England, Canada, US, and Ireland. And all those countries I just named, most of the immigrants don't end up going to a lot of these countries. And going forward, Australia and New Zealand, given what's going on in the South China Sea, is not going to be an attractive place to go either, with what's going on with China. So going forward, if you are looking to immigrate from India or a lot of these countries with a lot of, and you're bringing in a lot of money, Canada sounds like the perfect place to go, whether it be because of our healthcare system, our social structure. It's an amazing place to come and live. So going forward, you're going to see a lot more immigration into Canada, and that's positive for the housing market and the economy 5 years out. But in the near term, I am concerned.
And I appreciate that, guys. I want to sort of maybe shift here to the consumer. And I know, Gajan, you're talking about FOMO, and everyone's talking about the news and headlines. So Rohan, maybe you can sort of kick us off with this and then get a couple of your opinions. So what are your thoughts on the consumer and the impact on the economy?
So like I initially said, Akilan, consumer in North America represent 70% of the economy. So health of the consumer is key for the North American economy. And the thing that I'm very concerned about is something that Sri addressed, is employment. A lot of these people have been laid off. Unemployment is at a historic high, and people are expecting a V-shaped recovery. The problem with that is, again, I'm a very facts-based guy. Look at the US and Canada and see how many small businesses are there. Small business, there are 30 million small businesses in the US, meaning a company that employs less than 500 people. And in Canada, there's about 1 million small businesses. What's so important about the small business, Akilan, is that these small businesses employ 2/3 of the labor force in the US and Canada, 2/3. And what's happened to them over the last 4 months is that they've been traumatized by having to force and lay off all these people. Their balance sheets have been destroyed. There's no working capital for them. They have a liquidity crisis right now. For anyone to think that they're going to turn around and hire all these people back when things get back to normal, you're dreaming. So central banks are temporarily holding back defaults, but my concern is that unemployment is going to eventually pick up when the social payments by the governments stop. And I don't know when, but it's a matter of time before they do stop. You're going to start seeing higher unemployment. And not just that, it doesn't matter how much liquidity the central bank pumps, you cannot stop default rates picking up. There was a question about what does all this liquidity mean? In the near term, it can stop a financial shock to the system. That's exactly what the central banks have done. But over the next 9 to 12 months, companies are still going to go bankrupt. You're already starting to see that. And when they do, more layoffs happen. So this health crisis has turned into a financial crisis, and it's evolving, and it's going to get worse. So I would say, as a consumer, I would be concerned because the economy is going to get shocked from defaults going higher, company default rates picking up, and the consumer suffering. So I am very concerned about what's going on right now.
Perfect.
Yeah, and if I could just add on that, like I think, you know, it is true that the U.S. is a heavy consumer-driven economy, and normally that's been a really good thing, right? I mean, if you think about the manufacturing side of the world, where it's capital intensive and very labor intensive, they've been the supplier of goods, and then a consumer-driven world like the U.S. has been the consumer of goods. And generally the view is that the consumers are always strong, they're optimistic, and never bet against the American dream. We talk about America all the time here, but never bet against human capitalism and never bet against human ingenuity and all that stuff. And I think, I think if you take a really long-term view, that's true. Like, you know, 5 years out, is the world going to be better? And sure, like, you know, are things going to be better? Yes. But I think you can have increments of really bad times and good times. You know, the thing that scares me about the consumer and a consumer-driven economy like the U.S. is that consumer sentiment can change on a dime. Like, they can go from being very optimistic and very bullish to panicking and tightening the liquidity and cutting back on spending. And you saw that in 2007, 2008 during the global financial crisis, where, you know, a financial crisis turned into an economic crisis, partly because the consumer became very scared and they just cut back, right? So I think, you know, the one thing I do watch carefully is consumer sentiment. And right now the consumer sentiment is holding up, but I think, you know, there is a real chance that the U.S. consumer can one day wake up and think, you know, no one's got control of this virus. It's a full-blown pandemic, and there is no near-term solution. This is a long-term problem that we have to learn to live with and adapt with. And if you take that mentality, then I think a lot of things look different, and not necessarily for the better going forward. And I think so in that sense, you know, I think the consumer sentiment and how they react coming into the fall is going to be very important to kind of the future outlook for particularly a U.S. economy that's very consumer-driven.
Sorry, I feel like I have to be the positive guy again against you know, counterbalancing you guys, and it's tough. But one thing that we didn't touch on was the role of the government, right? We talked about the role of the central bank, but we didn't talk about what governments are doing, both in terms of Canada and the U.S. and the number of income and employment support programs that they've put forward to again support the economy through the pandemic, even though they're shorter term in nature. And so in terms of that consumer sentiment comment that Gajan was making, the amount of income support that we have seen has contributed to the rebound so far in terms of consumption, because incomes are being somewhat helped along by these income support programs. The danger is when these income support programs end and these people still do not have jobs. You know, at that point, that they will have to pull back on spending, and that could lead to, you know, a downturn because it being a consumption-driven economy. But will governments just stop providing those checks if people don't have jobs? And that's where I think they they won't necessarily. They've shown that they can do as much. They can continue to support the economy, and central banks will be very accommodative. There's some cooperation going on here between the central banks and the government in terms of them buying up bonds and now allowing governments to spend. And I feel like that would go through. We will see some more of that, because if we don't see it, whatever is a recession turns into a depression, and that we end up with an L-shaped sort of economic outlook, and that's much worse. So again, I'm a little bit more optimistic, because I think the governments will continue to provide support to both economy and businesses going forward.
Sorry, Akilan, I just want to add something to what Sri said. With regards to government support going forward. Now, I just explained to you why Trump is not going to get a second term, why Biden is going to come in, and he's going to, govern from the left. The problem with that is that his support base, like I told you, are going to be millennials and Gen Zs. These guys care about wealth disparity. They care about a ballooning deficit. So my point here is that, sure, under Trump, government deficit ballooned, but I think under Biden, it's going to come under control. People talk about modern monetary policy, and you can continue to print debt. I think that's all going to change under Biden. So you're not going to get a blank check from the government going forward. It's something to keep an eye on. There was another question about fixed income and how rates are so low. Where is opportunity going forward in fixed income? People used to tell me this 5 years ago. People used to tell me this 10 years ago. My bond fund this year returned 8% for the first 6 months. Look at Germany. Rates have been negative. Over the last 5 years, they've returned positive returns in Germany. So fixed income is always an asset class you need to have in your balanced portfolio. It's an asset class that's largely ignored by the retail investor. But if you look at just in Canada, TSX over the last 5 years has returned the same amount index bond fund has returned in Canada over the last 5 years, with 1/4 of the volatility that equities have returned. So when you as an investor looking at equities, do not disregard fixed income. There's a reason why investors hold fixed income. It's to preserve capital, generate income, and provide that negative correlation between equities and interest rates. So it almost acts like insurance. So always be mindful of how much fixed income you have in your portfolio, because during March, when markets are down meaningfully, people were happy that they had fixed income, core fixed income in their portfolio.
Appreciate that, Rohan. So you know what? I'm looking at a few of the questions that are coming in, and I know you guys are doing as good of a job to address them all throughout. So maybe I'm thinking right now, I want to just shift here to like sort of closing thoughts, right? And hopefully we can try to address some of the Q&A questions. I'm sure you guys have been reading that as well. So I'll let each of you take a stab at this. And we'll start off with you, Sri. What are the key messages that you want to leave with your audience? And let's sort of relate that to the overall topic of COVID and the financial markets.
Right. So at the start of the panel, I didn't expect to be the optimistic guy here, but I guess I am. As an economist, I wouldn't say to bet against human ingenuity, as Gajan has already mentioned. And I think the economy will recover, and the advances that we are making in terms of this virus and testing as well as vaccines, that will show up to some degree in terms of productivity as well down the road. So in the short term, it's likely to be painful, and that there's no disagreeing with that. We've already seen that, and the likelihood of another downturn in the economy, especially in the second half of this year, is rising, especially with the surge that we're seeing down south. But going forward from that, I do believe, with the support that we're getting in terms of the governments as well as the central banks, and that feeding through then to the economic recovery as a whole, I do think we get to some sort of sustainable growth rate later out in 2021. But I don't think we're stuck in this environment where people are stuck at home, not spending and leading into a negative growth trap for a very long time. So again, I'm a little bit more optimistic here, but I acknowledge that we do definitely have some downside risk in the near term.
Right. Appreciate that, Sri, and thank you very much for that. We'll pass that over to you, Gajan.
Yeah, look, I think there's, I'm of two mindsets here, right? On the one hand, we've been here before. We've had past healthcare scares and pandemics, right? We've had MERS, we had MERS, we had SARS, we had the swine flu, and we've got through that. People have got through that, markets have got through that, economies have gone through that. And so people tend to look at that and say, this too shall pass. And I think to some degree it will. On the other hand, this feels different. This feels much more structurally impactful and has a longer tail impact on the future of how things play out. And maybe sometimes, sometimes we tend to be prisoners of the moment and we overreact to things. But I do think, there are certain times in kind of, civilization or society where an event happens and that event alters the future course of future events, right? And I think this COVID could be one of those things where we look back and we say, okay, COVID did alter kind of the future trajectory of societies and how we think and how we live and how we work. And so, while I'm not trying to be overly dramatic about it, but I do think, when I think about the world going forward and both investing and how I think about how I live my life and my family and everything, I find myself looking at the world through a COVID lens. And I find myself asking myself, what does COVID mean for the future of what I'm going to do? What does COVID mean for the future of my investments? What does COVID mean for where I want to live and on all these things? So I think, COVID will have, and I think it does have a very large, broad-based impact on people's lives. And it's going to change the way people think. It's going to change the way people act. It's going to change the way people behave. It's going to change industries and businesses fundamentally. Look, I mean, if you look at travel and leisure and stuff like that, our baby boomers who are retiring, who are getting in their 50s, 60s age, going to be ready to pick up on a plane and travel all over the world again. I think they're going to be much more reticent to staying home and doing something more domestic. And millennials and Gen Z, they're going to be much more socially and active and thinking about what does COVID mean for generation and wealth gap and stuff like that. So I think, on the one hand, I think there will be a vaccine and I do believe in human ingenuity and progress. And I think it's almost impossible to stop that. But I do think, you can't just look at past history and say what worked in the past is going to work in the future. I think you have to be much more pragmatic about how you look at things. And I think you have to think as every opportunity in your life, every investment decision, every life decision, it's going to have some kind of COVID implication. And you should make that decision through a COVID lens and ask yourself, what does that mean? And I think that's going to be important going forward for a lot of people and a lot of aspects of their life.
Yeah, thanks for that, Gajan. Appreciate that. And Rohan, we're coming up to the hour, so I'll let you sort of close us off.
Yeah, I'll be fast here. I was fairly negative on this panel, and I truly believe, and I have a very strong conviction in my thesis. But there's a reason why we have an organization called Tamils in Finance. It's a support group for people like you guys. We are here for you. Things are going to get tough, but we are here for you. We are the safety net. If you're having difficulties, you can reach out to us. And you're lucky to live in Canada. You're already ahead of 95% of the world's population just being able to live in Canada. You have a great healthcare system. During times like this, I think about our people back home. They don't have any of this. I know we have a busy schedule. We get caught up trying to build our own career and make money. But it's times like these we need to take a moment to step back and give back to the community. I'm part of an organization called Goodwood. That's a global network of diaspora volunteers doing great work in affected areas in Sri Lanka, helping Tamil communities. whether it be that or mentoring young people like yourselves. It gives me great satisfaction. And, while I'm negative on the outlook for the economy, I get a lot of satisfaction and happiness giving back to the community. So I would encourage every one of you to reach out to us if you want to give back to the community. We are here for you.
Yeah, thanks for that, Rohan, and thanks to all four of you. So it was a great, very informative panel, and hopefully we can do more of these going forward. This is going to be the new mechanism, as you guys talked about, this whole digital acceleration for us to communicate with the Tamil community. So yeah, with that, like we'll end it off here. Everyone, just I'll ask you all to sort of stay tuned. And like Rohan said, like we're all open. Everyone's here. We're a small, tight-knit community. We all want to be as available as possible. So please reach out and stay tuned for more updates from Tamils in Finance. Thank you very much, everyone.
Thank you.
Thank you.
Thanks, guys.